Welcome to the Cash Flow Company. Today we're going to go over the differences between lines of credit, bank lines of credit, and HELOCs. Why you need them, why it makes investing so much more powerful, and how to put them in practice into your business. Let me go through an example of why this is so powerful. Here's a client who called in. He purchased 34 units last year. He keeps them all as rentals. And I asked him, what is your secret? How did you do it? And he said he has a $600,000 line on his other properties. So when the deals come up, when the wholesalers, when the realtors or whoever has the best deals, they call him because they know he could tap his line and within days close on those transactions. And he didn't start out that way. He started out 4 years ago with no properties. Now he owns over 124, but as you see, it's escalating. He's doing more and more. His first goal was 100, now it's 200. But he says the power behind it is that line of credit. As a real estate investor, there's two types of lines you can look at. HELOCs, which are home equity lines of credit, and you can put those on each particular unit you have, from your owner occupied all the way to your rentals, or a bank line of credit, where it's one line of credit on multiple properties. Here's where investors could use these lines of credit to purchase properties anytime, anywhere, just like we talked about with the example. To purchase a property at auction, which you really can't do with any other lender. Or use it for your rehab instead of putting in draw requests to all your lenders, paying your contractors, covering any overages that are there, or even just paying payroll or business expenses. That's where lines of credit come in handy for a real estate investor. So what are HELOCs and lines of credit? They pretty much have some of the same characteristics and a few differences. All they are is a mortgage or a lien on a property or several properties, typically in junior position, which means there already is a mortgage on that property and it's in second position. They can come in first position, but most of them are in junior lien position. It is something that you can use like a credit card, which means you can take the money out, pay it off when a project is done, and then reuse it over and over again. The nice thing about these lines, these HELOCs and the lines of credit, is you never have to ask for permission to use them. You don't have to requalify every time you do a deal. That is what is nice about these lines. It gives you the speed, the flexibility to buy what you want, when you want, or just pay for whatever you need to get that project done. But what's the difference between a true bank line of credit for your business and HELOCs you take out in your properties? So number one, let's start with qualifying. Typically when you're talking about a bank line of credit, which is a line of credit on one property or multiple properties, you could have one line of credit that covers all of your properties or just part of them. You have that flexibility, but it does take you providing all the paperwork, all the taxes, everything that a banker usually requires, you're going to need for a bank line of credit. Now for a HELOC, qualifying is typically just as simple as getting an estimate or value on your property, having a good credit score, and typically it has nothing to do, or they don't ask a lot about your income. Now, since we're talking about qualifying, let's talk about applying. The big benefit of HELOCs is once you get one, they're good for using it like a credit card for that draw period. So it's usually 5 to 10 years. Once you get them, they're there. They're not going to call them. Nothing's going to happen to it. You could use it over and over. Now, a true bank line of credit that goes to your business, they're going to want to look at your financials, some every year, but at least every 2 years. So they're going to have you requalify every couple of years. So the downside there is you have to bring your paperwork in every couple of years, got to make sure your business is always profitable, and they're going to reevaluate the property's value. So that could be a positive or a negative if they think the market is, going down a little bit. Next up is LTVs. What are they going to lend you? HELOCs on non-owners, it's probably max 70%. Owner occupies, you could probably get up to 80%. So there's a mix there depending on your credit and depending on the properties. The bank line of credits, they'll probably go up to a maximum of 75% average overall on the properties. Now the LTVs are not that different, between the HELOC and the bank line of credit. Just shop around, look around, and make sure you're maximizing your loan to value on whatever product you get. Now let's talk costs. What is it going to cost for these transactions? Typically on a HELOC, it's going to cost a few $100 each time you do a HELOC. So each project, each property will have its own fees and requirements. Every time it's going to be a couple $100 for the HELOC. But remember, That is for that 5 to 10 years as long as you never refinance it. Now, cost for a bank line of credit, it's going to be somewhere between 1 and 1.5%. They may need some appraisals in there. And just remember, since it's a 1 or 2 year limit on what they do, there will be charges at least every 2 years. Now, the biggest benefit of a bank line of credit, it's at one source. Unlike HELOCs, you have a small amount or a small loan on each property. So if you need a large amount, you're going to have to go to each bank or each credit union and pull out certain amounts. And you're going to have different accounts at different banks, and you're going to have to manage them. You're going to have to take care of the accounting for them and make sure there's payments. A bank line of credit is one line of credit. It's one source. When you need the money and you need the funds, you wire from one bank. Bank lines of credit are easy to use, especially when you're using them for multiple projects or they're larger. HELOCs are more segmented because it's per property. So you may have 2 HELOCs, you may have 10 HELOCs. You may have to put them all together just to fund one project. So the benefits of HELOCs are they're fast, easy, and they'll stay there for 10 years. Bank lines of credit, it's one source. It's from one place, but every year to 2 years, you have to requalify. So they both have their benefits, they both have their uses. Whatever makes sense for you is what you should be focused on. It's sometimes hard to figure out what's best and what banks will work with you. That's what we could do here at the Cash Flow Company. We are set up, we call the banks, we're in contact with them. If you have a question or if you need the services of someone finding the best line of credit for you, reach out to us today and we'd be glad to help. Also, check out our website. We have a lot of free tools that help you become a better investor, or at least get cheaper, easier, faster money. If you want to keep the money train rolling, we'll see you on the next video.